Well, the Canadian dollar is trading at its highest level since April this morning. To find out what's driving the dollar higher and how this week's rate decision by the Bank of Canada may play into the story is Adam Button. He's Chief Currency Analyst at Forexlive, and he joins us now. Adam, thanks a great deal. If I'm not mistaken, I think you believe the Canadian dollar is overvalued and could be on a path towards 74 U.S. Cents per 74 U.S. cents per loonie before too long.
Right. The big drag on the Canadian dollar in the coming months is going to be housing. I think a few months ago there was a lively debate about where we're at, and I think now there's been more of an acceptance or realization that Canadian home prices are falling. You referenced a survey from earlier today that showed expectations of falling prices, and I think that's slowly going to become embedded, even more so as the Bank of Canada cranks up interest rate hikes. So the question really then becomes is how does that affect the consumer and the Canadian economy indirectly? Will consumers spend less, or has this been a case of sort of found money coming in so quickly with the rapid home prices that we had to it disappearing and people basically carrying on as it were? And there isn't a great playbook for that. But with global growth slowing, the Canadian dollar is in a vulnerable spot, even with the Bank of Canada hiking. What's held it up so far has been the remarkable and almost unprecedented resilience in oil and gas prices. And that points to a supply shortage that could be worsened in the months ahead. And that's keeping the Canadian dollar at these levels. We're right in the middle of the last year's range. And it'll be interesting to see. At this point, it's looking like oil will hold up. If it hasn't fallen on a terrible stretch in the stock market, concerns about global growth, and a 2-month-long China lockdown, then it's hard to see oil declining from here.
And what about the ever-present dynamic of expectations expectations on the Bank of Canada and its rate hiking path versus the United States, and which central bank will raise by the most? Where do we stand there now?
Yeah, I think the market is really sensing, very comfortable with the idea that it will be essentially in lockstep. I mean, whether we're 25 basis points up or down, the bond market is going to put that premium into treasuries anyway. So we're looking at 50 basis points this week. That's in the bag. Probably an 80% chance of 50 basis points again next month. And I think at that point, and even this week, the questions about housing are key for Tiff Macklem. He's been a little bit blasé on the way up about home prices rises getting away. And on the downside, if there's a sense that he's cheering on declines or he's essentially indifferent or even welcomes it, then I think those expectations of home price declines could start to feed on themselves, or we could start to see some anger around that dynamic play out. So he's walking a very fine line there. If he comes in guns a-blazing on, we're going to hike no matter what, we'll hike until inflation is tackled. Now, that's a low likely probability because I think the Bank of Canada realizes that the Fed, global central banks really need to work together. These are largely supply chain problems. But the Bank of Canada limit is probably 2.5%, given what we're seeing in housing, maybe only even 2%, whereas the Fed is more likely to go above that. I don't think they'll stay above that for long, but that dynamic should underscore U.S. dollar appreciation towards the latter half of the summer.
What about Canadian household debt, which for a long time has been elevated, more elevated than it is in the United States? What about the risk to the Canadian consumer in terms of household debt as rates move higher?
Yeah, that's absolutely it. And it feeds back into the housing price question. Now, some of that is overstated because a Canadian might have $500,000 in mortgage debt on $1 million house, right? So you have high debt level, but your wealth level is far in excess of that. So there's not really a big risk there. Now, if a home price gets cut down to $750,000, well, maybe you don't have that margin of safety anymore, and you're not tapping those home equity loans. But what we've seen so far is people aren't overly indebted, but investors have leveraged up on the house price front, and if that starts to come online, people start to feel less wealthy, then they spend less, then the Canadian consumer could be in for a real period of retrenchment. Once we get maybe past this summer of everything's open again, people are happy to be back out, could start to really kick in towards the latter half of the year, Q3, Q4, and the Canadian consumer starts to disappoint. But there's no sign of that just yet.
As you know, the governor of the Bank of Canada has been taking some criticism, mainly from the leading contender in the Conservative leadership contest. Does Tiff Macklem's quote-unquote credibility come into play here?
No, I don't think it. I mean, we're in this era now of political shots, and I think Tiff Macklem has left himself exposed by some of the things he did, obviously well-meaning about promising to keep rates low. And now Canadians are really feeling the effects of high rates, and he's going to continue to hike them. So he's going to be a punching bag. It's probably going to get worse in the next 6 months. Now, does that affect where rates will be, where the Canadian dollar will be? I don't think it does. And we're likely a long ways away from a federal election anyway. So ultimately that probably gets shrugged off, but it speaks to perhaps the growing sensitivity of consumers to higher interest rates.
Why don't we finish with the U.S. dollar? What's your expectation on the U.S. dollar, not versus the Canadian dollar, but versus other major international currencies?
It's important to keep in mind as well, the Canadian dollar is at a one-month high, but a lot of that is the U.S. dollar coming off the boil on a lot of fronts. And I think that weakness in the dollar speaks to some of the financial flows that have kept the U.S. dollar ultra elevated really for the past couple years, because a lot of that was going into tech stocks. Obviously, the U.S. is a safe haven as well. You know, the tech bust is on now, and I think investors, global investors, are trying to find places that offer more value. And, you know, the U.S., the multiples in the U.S. are higher than almost anywhere else. Canada's cheaper for one. They're looking for that commodity exposure. So some of that money is flowing away from the U.S. But be careful with the euro. Inflation, again, super high today in Germany. And, I mean, Europe today with sanctions on the EU saying, well, it's only money. I don't think Europe's particularly interested in economic growth, and there are a lot of downsides for the euro, and some of that will flow back into U.S. dollars.
Adam